Hello and welcome again. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Thank you for joining us on this Tuesday, September 21st of 2021. Got a lot moving the markets. Markets are extremely volatile, so it's a lot of fun to watch. So let's get right into it, and thanks for watching. So right out of the gate, we're talking about volatility and ultimately what the next bearish game changer is. Obviously, we saw a lot of volatility in the last week and a half or so, which is really that time of the year. So it's seasonality. We're in the low right now in terms of earnings reports. We're waiting for those to come out. But in the meantime, markets always sort of, as we transition from summer to fall, markets are literally looking for any bear market news they possibly could. Could it be the GDP deceleration that we're in? Could it be the anticipation of earnings being a disappointment on a go-forward basis? Or is it the headlines of the last few weeks, like I put up on the board right here, which is China's Everground. If you don't know about this, kudos to our investment committee, especially Corbin on our team. He brought this on the forefront literally weeks and months ago. And so we've been well prepared here at Blanke Schein Wealth Management for our clients. We've raised cash. We've put our portfolios in sort of a diversified balance position and just to double check and prepare for the September volatility. Again, it is seasonal, always this time of year, September, October. It really is one of those things where it's just take a deep breath and get ready for that Santa Claus rally, which we believe we will have. And so we raised cash. We're in a good position. Market's sort of coming our way for our shopping list. Our high conviction list is what we call it. So we're excited when we see volatility like this, opportunity. And again, if you have bank cash, bring it over because we'll put it to work for you, because I know they're not doing the same for you right now. But China's Evergrande issue, if you're not paying attention right now in China, has a major problem with the largest commercial sort of real estate firm that is over 1,300 properties and investments. They have investment division. They have sort of their biggest real estate developer, second biggest real estate developer. The richest person in China at one point in time is the owner and CEO. And so they can't pay their bills. This week, they have so much leverage and so much debt right now on the balance sheet and so many entities around the world, over 280 different countries they're operating in, all their different entities, that it's really a bubble waiting to pop, because right now there's unrest in China. People want their monies back. I mean, there's over 1,000 different sort of condos that they're ready to build that they've taken the deposits on, that people are at the doors right now in China, like literally at the doors of the headquarters, trying to get their money and their deposits back for something that hasn't even been built yet. So there's a lot of fear of contagion, if you will. And the reality of all the research that we've done is we believe it's not the Lehman Brothers moment that we experienced in 2008 here in the U.S. Again, our U.S. banks, as a result, are really fortified 3 or 4 times over. So we've learned our lessons here, and there's not sort of much, there's containment because China is a closed market for the most part. Now, will there be a spillover effect, sort of international banking? We're monitoring that. We don't believe so. In fact, we believe that China will have sort of a long-term capital management workout internally, maybe not by sort of the community at large of other competitors like they did with long-term capital, but maybe China itself, the CCP, simply because if you think about it on the global stage right now, if this big player starts cascading down and creating sort of contagion within China and sort of a domino effect of sort of just fear in the marketplace, you're not only going to have the real estate market, you're going to have all the other markets that are interconnected in China. And so China also, on the other hand, globally speaking, is number 2 in terms of GDP growth, right behind us. And they are vying for their 5-year plan, their 10-year plan, their 100-year plan to exceed the United States. So right now, the $300 billion that really is at stake right now is small sum to pay for China, who's publicly said they're not going to backstop Evergrande on this particular situation. They're just going to let the free market work its way out. We think it's a smokescreen. We really believe that there's too much for China to lose internally in that marketplace, and then their GDP, if they go through a recession, would shrink. Therefore, that would put them sort of, who knows, maybe 5 years behind us in terms of trying to pass the U.S. and their GDP growth, maybe 10 years. So I think personally there's going to be a workout, we believe, here at Blanke Schein Wealth Management. But again, there's always that bearish sentiment that's building and contagion, so that confidence could change at any point in time. So we're paying attention to it. That's under the bearish sort of game changers globally. That could be a contagion. The Delta Delta data right now. If you look at sort of high frequency data, obviously airlines are offering a lot of deals right now. I don't know if I have all the emails that I get, and I'm getting a bunch of emails. So if you want to sort of buy some tickets or for a later date, I will tell you now is the time to do it, because airlines have seen sort of a Delta data sort of pullback in terms of booking. So it's an advantage to you at home. So when you're ready and willing to travel, go out there, but get a deal right now and see if you can book it right now. Take advantage of that. But the data is really showing in some places geographically around the world that it's rolling over for the benefit of humanity in this case. So that's a positive, but right now it's going to sort of disrupt supply chains and all the other sort of variations that we're finding sort of from travel and a few other things. So right now we don't see it continuing to be a huge threat, but it is sort of a short-term sort of something to keep on the radar in the meantime and monitor. But tomorrow it's the Fed meeting. We believe you should be paying attention to the most important meeting, if not more important now than ever, all year. Here's why. Right now, the Evergreen situation, which is an international situation, you have the geopolitical stage right now and all of sort of what Washington's dealing with, and it doesn't look too much, let's put it this way, there's not too much political will right now, or political clout or capital, if you will, from the White House to then lean on Congress. So that then puts in the next package, the next bill, the $3.5 trillion bill, sort of squarely in the sort of we don't know stage right now. So that usually the White House thrives off their political capital. Right now, not so much if you are paying attention around the world and both here and abroad. So that's sort of putting into question Congress's ability to actually get that $3.5 trillion package through. So we will wait and see over the next 3 to 4 weeks how that plays out. Again, we have the debt ceiling. It's another bearish opportunity there to pay attention to and worry about. Let's just keep adding them up. But more importantly, the Fed meeting. And the Fed meeting right now, all the negative news that I just brought up is actually good news. Rob, what do you mean? Why are you saying that? So conventionally, when the Federal Reserve is just about to start tightening, and that's what tomorrow's meeting was all about. They're about how they're going to take away the punch bowl from the party, how they're going to have to remove accommodations right now, and ultimately, Federal Reserve's job is to slow down the economy when the economy is growing so rapidly. Well, because of Delta, because of China's instabilities, because of all the geopolitical unrest, because of Congress may or may not get this bill passed in time, who knows? There's a lot of question marks out there. So those negative news then translates into the Federal Reserve might have to hold off as to what they were originally planning on doing, because they have to be more supportive in the short term. It's like you helping your children, just being more supportive in the short term as they get back on their feet. Because the last thing you want to do is push them out too quickly, financially speaking, because then that becomes your problem all over again. So might as well give them a little bit more room to run, i.e. in this case, the U.S. economy. Let it grow a little bit more. But why we need to raise interest rates at some point in time? Well, the Federal Reserve has to think about tomorrow as well, which is get the interest rates to a certain level that if there ever is a recession, of course we have a recession every 5 to 7 years, then they have some basically tools in the toolbox to lower the interest rates to accommodate that recession at the time. Right now we're in a really good, positive, sort of stable growth environment for the economy. So they're saying, wait a minute, let's take away the punch bowl. So really what we want to listen to, this could be a moving event for the markets. That's why I saw the markets were down on Evergrande on Monday, Evergrande news, China's news on Monday, but then they're bouncing up sort of back and forth today as I film this, simply because they're anticipation of the Fed meeting. Now, what to pay attention to, what to listen to, or listen for, here's what's most important. What's expected? What's expected is that the tapering is to begin in November. They've already said this, tapering by $15 billion per month, and ultimately that means that they're not going to buy as much as or accommodate as much as they have been, and so they basically, that's the benchmark right now. And then they're also going to announce their dot plots. And we'll talk more about that in another episode in the future, because it's fun for me, boring for you, but it really means mortgages and interest rates and housing and affordability and sort of markets. And so it has implications as to when the Federal Reserve is going to raise interest rates. And they talk about it in their dot plot in 2022, 2023. And they say, hey, in 2022, we expect 2 interest rate increases from Fed funds rate of 25 basis points right now. So at the end of 22, theoretically, we could be at 0.75, so 75 basis points, and then so on and so forth from there. That's what's expected. Now, here's what could happen. Markets could go up as a result or hit another air pocket because if they are hawkish, meaning that they are going to do less accommodative measures of $15 billion per month, or no, excuse me, greater than. They're gonna start, instead of just doing their stated 15 billion in terms of reduction of purchases, they're going to reduce much more. They're going to increase much more than that. Sorry, I'm a little confused here, but the reality is that they're going to start taking away the punch bowl sooner than later. And they also talk about we're going to have more rate hikes in 2022, more than 2, which is expected, which is going to disrupt markets all too well. So we don't believe any of this is going to happen. We believe that the Fed's going to be dovish, which means that the 15 billion, they're going to either stick to that number or they're going to do a little bit less than 15 billion in terms of reduction. And then they're going to say, maybe we have to hold off and wait and see what this data really comes out in the next couple of months to show them that whether they go by the dot plot of raising rates by 2 times in 2022, or they say, hey, we're going to be lower for longer. We believe it's sort of going to be a tightrope. They're going to have to walk the line on this. But it's going to be really exciting to watch, because that's what's going to be moving markets tomorrow in the most exciting day of economics in the Federal Reserve and the U.S. economy, as I love to watch this. So hopefully you do too, but if not, that's why you have us. We're paying attention for you, and we're balancing, and we're taking advantage of it where we need to. While you do what you love to do, which is time away or grandkids or travel or just what you normally do for you to be at your best. So we're here for you. So thanks for watching. I hope this sort of goes through the big picture of why the next 24 hours is going to be really exciting, and we'll see you again next time.